The world is holding its breath. From the bustling streets of New York to the financial hubs of London and Tokyo, a sense of unease is rippling through the global economy. The warning signs are not just flashing, they're screaming. We've seen this before, haven't we? The whispers of 2008, the dot-com bubble, the ghosts of recessions past. But this time it feels different, more complex. The question on everyone's mind isn't if another recession is coming, but when and how bad will it be? Today we're diving deep into the signals, the data, and the expert opinions to understand why the next recession might be much closer than you think. Let's start with the most glaring red flag: debt. We are living in an era of unprecedented debt. Globally, government, corporate, and household debt have ballooned to levels that make previous crises look small. Think of the global economy as a massive ship. For years, we've been loading it up with more and more weight in the form of borrowed money. This was manageable when interest rates were near zero. Borrowing was cheap, and it fueled growth. But now central banks around the world are hiking rates to combat inflation. Each rate hike is like a wave hitting our overloaded ship. The cost of servicing this mountain of debt is skyrocketing. For governments, this means less money for public services. For corporations, it means tighter margins, potential defaults, and layoffs. For households, it's mortgage payments and credit card bills becoming unbearable. This debt bomb is ticking, and the fuse is getting shorter. Next, let's talk about growth, or rather the lack of it. Major economies like China, which for decades was a powerhouse of global growth, are slowing down significantly. Their real estate sector is in turmoil, and consumer confidence is weak. In Europe, the energy crisis and geopolitical tensions are putting a huge strain on industries. And here in the United States, while the job market has shown resilience, that strength is beginning to fade. We're seeing major companies, especially in the tech sector, announce massive layoffs. These aren't just numbers on a spreadsheet. They represent real people losing their income, which leads us to our next point: consumer spending. Consumer spending is the engine of the modern economy, accounting for roughly 70% of GDP in the US. When people feel confident, they spend. When they're worried, they save. Right now, people are worried. Inflation, while it has cooled from its peak, is still eating away at paychecks. The cost of groceries, gas, and housing remains stubbornly high. As a result, people are cutting back. They're delaying big purchases like cars and homes, and they're being more cautious about everyday spending. This slowdown in consumption sends a powerful ripple effect through the entire economy. Businesses see their sales decline, so they reduce orders, cut back on investments, and ultimately lay off more workers. It's a vicious cycle that can quickly spiral into a full-blown recession. So what are the experts saying? It's a divided camp which is unsettling in itself. Some economists believe a soft landing is still possible, where inflation is tamed without causing a major economic downturn. They point to the strong labor market and resilient corporate profits as signs of hope. However, a growing chorus of analysts and financial institutions are sounding the alarm. They argue that the sheer scale of the debt, combined with the aggressive rate hikes and geopolitical instability, makes a recession almost inevitable. They look at indicators like the inverted yield curve, a classic recession predictor that has flashed red for months. This is when short-term government bonds pay a higher interest rate than long-term bonds, signaling that investors are pessimistic about the future. Historically, this indicator has been incredibly accurate. Let's add another layer of complexity: the geopolitical landscape. The world is more fragmented than it has been in decades. Ongoing conflicts, trade disputes, and a general retreat from globalization are disrupting supply chains and creating uncertainty. Businesses can no longer rely on the stable, predictable global marketplace they once did. This instability makes it harder to plan, harder to invest, and adds another layer of risk to an already fragile system. When you combine this geopolitical friction with the economic headwinds we've discussed, the outlook becomes even more concerning. A sudden flare-up in tensions or a new trade war could be the spark that ignites the financial tinderbox. So how does this all impact the average person? It's not just about numbers on a stock chart. A recession means job insecurity. It means your retirement savings could take a significant hit. It means it could be harder to get a loan for a house or a car. The value of your assets might decline. It creates a climate of stress and uncertainty that affects families and communities. But this isn't a message of despair. It's a call for awareness and preparation. Understanding the risks is the first step toward protecting yourself. This is where financial literacy becomes your superpower. Panicking is the worst thing you can do. Selling all your investments in a downturn often means locking in your losses. Instead, this is the time to be strategic. First, review your budget. Understand where your money is going and identify areas where you can cut back, if necessary. Building an emergency fund is crucial. Having 3 to 6 months of living expenses saved in an easily accessible account can provide a vital cushion if you face a job loss or unexpected expense. Next, look at your debt. With interest rates rising, high-interest debt like credit cards can become a major burden. Focus on paying it down as aggressively as you can. When it comes to your investments, don't make rash decisions. If you have a long-term investment horizon, a recession can actually be an opportunity. Market downturns allow you to buy quality assets at a discount. This is the time to review your portfolio, ensure it's well diversified and aligned with your risk tolerance. Maybe it's a good time to consult with a financial advisor to help you navigate the uncertainty. Knowledge is power. Don't just watch the headlines. Understand the forces behind them. Learn about different asset classes, stocks, bonds, real estate, commodities. Understand how they behave in different economic cycles. History shows that economies are cyclical. Downturns are followed by recoveries. The investors who weather the storm and even thrive are the ones who are prepared, who remain disciplined, and who see opportunity where others see fear. The signs are clear. Rising debt, slowing growth, shrinking consumer spending, and geopolitical turmoil are all converging. The next financial storm might be closer than we think, but being forewarned is being forearmed. This is not the time to be scared. It's the time to be smart. It's time to build your financial fortress, to educate yourself, and to prepare for the challenges and opportunities that lie ahead. The financial landscape is shifting, and those who understand the currents will be the ones who navigate successfully to the other side. Thank you for joining us on this deep dive. The economy is a complex machine, and we're here to help you make sense of it. For more financial insights and market secrets that can help you protect and grow your wealth, make sure to subscribe to FinSparrow. Stay informed, stay prepared, and we'll see you in the next video.